All right, joining me is Kai Wu, founder and chief investment officer of Sparkline Capital, who is behind two ETFs that focus on intangible value, which, in a nutshell, these ETFs are seeking exposure to stocks that appear undervalued when taking into account intangible assets. So we're talking about things like intellectual property, brand equity, human capital, network effects, those sorts of things. But here's what's very interesting as it pertains to crypto. Kai is essentially using this same framework to identify undervalued crypto assets. So he runs a crypto hedge fund that relies on intangible value. And he's also applying factor investing to crypto as well, which we will get into all of this. Kai, it is so great to see you again, and welcome to the podcast.
Yeah, thanks so much. It's been a few years since I was last on the ETF side.
Yeah, and it's funny because you and I have chatted several times over the years on, I call it the TradFi side with your ETFs. But then a few weeks ago, we actually ran into each other in Las Vegas at the Exchange Conference. And I don't remember how, I'm sure I brought it up, but crypto came up in our conversation. And you mentioned to me this very interesting approach that you're taking to investing in crypto. And that really piqued my interest. I think people who listen to this are going to find your approach fascinating. But I'll be honest, Kai, I didn't even realize that you were involved with crypto. And so I guess let's maybe start there. Like, how did this all come about with a crypto hedge fund?
Yeah, so I guess I should go way back to 2014. So I was at the time just left GMO, where I was part of Jeremy Grantham's asset allocation team, and kind of looking at what to do next. And I don't know exactly who it was. Someone in my college alumni network, I think, brought crypto into my field of vision, and I was like, this is a really interesting technology. And again, it's super early. I think the market cap of the entire crypto asset class was $10 billion back then. This was again early 2014. And I was like, look, like I come from the TradFi world. I come from a quantitative asset manager. This is a frontier asset class. This is a market that, like if I was lucky enough to be trading FX in the 70s, this is kind of what I imagine it was like, right? Or an early pioneer in say high frequency trading or market making. So I was like, this is pretty cool. Let me kind of start playing around with it. And that led to the development of a few different arbitrage style strategies. So I mentioned on the FX side, one interesting thing you could do was these triangle trades, where you could basically look at three different currencies, look at two legs as opposed to the third leg, and if they were mismatched, there was a trade there. There was cross-exchange arbitrage, right? So the price of Bitcoin on an exchange in London versus in the US. Again, these classic opportunities that still exist today, but more episodic than they used to. And then the third thing we did was market making. And when I say market making, it was basically just putting limit orders in to buy low, sell high. And what's kind of fascinating here is you think about how mature the traditional finance markets are now, where you would need a $1 billion setup, co-location with NYSE, and a bunch of PhDs to do this within equities. I was doing it by myself on like a Python script on like an AWS micro instance, if that gives you a sense for where the market was in 2014. So that was really fun, but it was kind of more a personal passion project at the time. Then what happened was I was recruited by a guy I used to work with at GMO to start a hedge fund, a quantitative hedge fund, which we did, and it was successful. And then I was there for about 5 years, and then 2018-19, I left to go start my own firm, Sparkline Capital, which is what I'm doing now. And then, to the point here, I think I was on your podcast a few years ago when I was just launching my first ETF. And, again, as you mentioned, the idea was to invest in stocks with undervalued intangible assets. And what was interesting about the approach was that it was a value strategy, but unlike traditional value funds, which tend to be very focused on financials and energy and hard asset businesses, the portfolio, when applied through an intangible value lens, right, ends up being a lot more kind of modern in its sector composition. It ends up holding a lot more technology, life sciences, consumer brands, services businesses. And so that led to this kind of next insight, which was, can we kind of combine these two threads, right? And around this time, just early 2022, late 21, was when crypto markets were again very much in vogue. And I had investors reaching out saying, hey, your approach is really interesting because it allows us to take this time-tested value methodology, but apply it into the modern stock market, right? The kind of intangible half of the stock market. What about crypto? Can you do it there, right? Because if stocks are 50 to 80% intangible these days, crypto is 95% intangible. And so it kind of made sense as a place to go. And I had an interest in the technology from kind of the early days. And so I spent some time doing some research and development, tested the strategies historically, built some models, kind of ported this framework of, as you mentioned, the 4 intangible pillars into crypto. Obviously, the data sources are different, and we can get into exactly what needed to be changed to make it work in crypto. But yeah, it looked really promising, and we ended up kind of launching April 2022, so right before Luna. So the timing was, could not have been worse, but it's now been 2.5 years, and we're still at it.
And we'll obviously get into a much deeper discussion around how you're applying intangible value to crypto and talking factor investing in crypto. But if we just start at a high level, I'd love to have you explain sort of the problem that you're attempting to solve here by applying intangible value and applying factor investing, because people look at crypto. Certainly Bitcoin gets a lot of headlines, Ether, a lot of the big layer ones, but there's this long laundry list of crypto assets out there. And so I'd love to have you just talk about that and why you think there's a need to take the approach that you're taking to investing in crypto.
Yeah, so I think there's a 2-step process. So put aside how I'm approaching it, let's step back even further and ask the question, which is, do we think that the majority of folks who even own crypto at all are appropriately diversified, right? The most people don't own crypto, but those who do will generally just own Bitcoin and say, hey, look, I own Bitcoin, that's pretty good, right? Let's call it a day. But look, there's 500 liquid cryptocurrencies out there, and Bitcoin is obviously the biggest. It's about half the market cap of the entire index, maybe a bit more now, but it's just one thing, right? The analogy would be to say, I'm not going to buy the S&P 500. I'm going to buy Apple instead and just call it a day, right? That doesn't make much sense when you put it that way. And so, my thought process here was, look, most investors have Bitcoin or can get Bitcoin like exposure. Again, 2022 was before the ETFs came out, and that's obviously, kind of commoditized the thing. It was grayscale beforehand, kind of pushed fees down, and that's basically a solved problem at this point. But even back then, it was pretty clear that that was coming eventually. And so the idea was, look, you don't need me to help you buy your Bitcoin, right? That's something you can do on your own, or through some of these other excellent folks out there. But what's much harder is getting exposure through to assets 2 to N. And I guess the question is, why do we need this? Like, why do we need to diversify? Why not just own Bitcoin? And I think there's a few arguments. First is this idea that Bitcoin is, at least today, and the narrative has changed through time, but today it's called digital gold. But obviously, the problem that, say, Ethereum is trying to solve, right, being kind of a computing layer or a smart contract platform, and then you kind of go down the stack all the way to like the application layer, which have all these long tail of cryptocurrencies. We have a framework at Sparkline where we have basically 4 sectors. So platforms includes Bitcoin and Ethereum. And then we have, finance, so that's decentralized exchanges and lending protocols, media entertainment, which is effectively disintermediating Hollywood. And then, of course, the infrastructure layer, which is, decentralized cloud computing and GPUs, your Filecoins, your Heliums, DeepIn, et cetera. And so you think about it is, Bitcoin, even if you own Ethereum and maybe some Solana, you're still only getting exposure to one category of projects here. And so you're missing out on, a lot of interesting innovation in the space. And I think if you go back to the lesson of history, which is when technological revolutions come about, one thing you find is that oftentimes the first mover or the early front runner isn't necessarily the ultimate winner in the space, right? So think of like Friendster or MySpace or AOL or BlackBerry, right? Yahoo, ultimately supplanted by the Googles and Facebooks of the world. And so yes, Bitcoin's the biggest asset today, but there are all these other things being built as well that if you're only investing in Bitcoin or only investing in Bitcoin, ETH, and Sol, you're missing out on. You go back to the 1990s to take the AOL example, and you say, all right, I have this like really bold idea that I think that the internet will become a game-changing technology and will change the way the world works. Therefore, I'm going to buy AOL. right? You would have been very sad because you made the right macro call, stuck your neck out, and lost money, right? Like Amazon was one of the small caps at the time. So you really need to think about how do you build a diversified portfolio with this idea that the winners can come from anywhere, and that includes this long tail of cryptocurrencies. So I think that was what kind of got me thinking about if there's a product that needs to be launched, right? The world doesn't need another hedge fund just for the sake of doing it. What they need is a specific problem to be solved. In this case, access to the small cap crypto universe.
2 points here that I want to follow up on. One, you had mentioned to me that diversification beyond, say, Bitcoin and a few of the layer ones historically hasn't necessarily worked fantastic, right? But you believe that could be changing, which is why your approach you believe is important. Can you talk a little bit about that?
Yeah, look, and admittedly, I was definitely early on this call, and hopefully not wrong, hopefully just early. Let me say that. But look, the same thing has happened in stocks, right? So let's go back to the stock market, since I know we both have a traditional finance background, which is we've all been taught, whether in CFA or whatever, that diversification is good. It's a free lunch. You can kind of reduce your risk without reducing return. Amazing, right? 1/n, great. Now the things that hasn't worked the past decade, right? The idea is. The idea of diversifying globally has us underperformed the S&P, which has underperformed the mega cap Magnificent Seven, Apple and Nvidia, right? So just buying the top thing has actually done better than trying to waste your time, buying European value stocks or emerging market stocks, right? So yes, it's been the case that at least past performance has not been kind to this idea. And there's an analogy, of course, in crypto where Bitcoin has done really well the past few years, whereas altcoins have not done well at all. I mean, by some measures, they're down 50 to 80% now from a few years ago, right? Which is this huge kind of K-shaped return pattern. And to some people, that says that invalidates this altcoin thesis or this idea of diversification. Diversification is dead. Why should we mess around with anything besides Bitcoin? But that's very backwards looking, right? Past performance does not predict future performance. And, we'll get into it in a second, but, there are some things I'm looking at that have, they're starting to kind of indicate that maybe things are finally starting to change. So I think actually one thing we kind of corresponded about via email was this idea of the fat protocol thesis. So I think people are probably familiar with this, but just, for background, basically, this was written in 2016 by a guy at a VC fund, and it was very influential in terms of capital allocation within crypto. And the idea was this, which is in the internet era, there's kind of two categories of assets. There's the protocol layer, which in the internet would have been TCP/IP or HTTP, and then there's the application layer. In the internet phase of the game, the application is won, right? All the value is now captured by Google and Meta and Amazon, and basically nothing by TCP/IP. His contention was that fast forward to today within crypto, the opposite would be the case for a variety of reasons. But his idea was, it's going to invert now. So we'll have not fat apps, but fat protocols, where blockchains such as Bitcoin and Ethereum are going to capture all the value. And then the application layer is going to be this thin layer on top that might entice people into the category, but it's not going to be able to kind of capture any value. They have no moat, so to speak. And that was, broadly speaking, well, actually very prescient, I'd say. He nailed it, right? For the next 10 years, he went on to be, that idea was completely correct, right? Today, if you look at the market caps of cryptos, if you look at the four categories I mentioned, so platforms being kind of analogy to protocol layer, and then the other three application layers, you have about equal number of tokens in each one just by count. So, platforms would be 25% of the number of cryptos out there. But if you look at the market cap, it's 90%, right? So 90% of the value of cryptocurrencies are, Bitcoin plus ETH plus Solana, Ripple, etc. And so that's obviously been the correct way to invest up until now. Now, what's kind of interesting is, I actually wrote about this in my last investor letter that came out at the end of March, which, unfortunately is not public, but, maybe could kind of carve out a piece. But I had a really interesting exhibit where I showed the revenues earned by protocols. This is using data from Token Terminal. They're great for the top 20 projects. And one thing that was really interesting was that of those 20 projects, only 4 of them were layer 1 blockchains. So that was Tron, Ethereum, Solana, and Binance. The other 16 were applications, right? And some of these were stablecoin issuers, others were DEXs, so DeFi, decentralized exchanges. And what was kind of interesting from this in particular was there were actually, I think, about 5 different Ethereum style projects that are built on Ethereum that earn more revenues than Ethereum itself. And not just ETH, right? So Solana is the same way, where there are 2, I think Pumped Up Fun and Jupiter actually earned more revenue last month than Solana itself, right? And this is kind of a huge narrative violation. If you now go back from the top 20 to the entire set of universe of assets we have data on, what you find is that 70% of the revenues are earned by the applications and about 30% by the layer ones, right? If you go back even 4 years ago to 2001, it was the opposite, where 95% of revenues were earned by layer ones and only 5% by applications, right? So the world truly was fat protocol back then, but now it's becoming, or at least as of recently, become fat app. And we all know the problems around what Ethereum's been going through, which is a big component of this too, and this may kind of mean revert. But I think that this data point is, I think, pretty powerful as a potential illustration of why things might be turning around.
So you'll be pleased to know I actually read that newsletter, and that stat just jumped off the page to me, where you said, these 5 applications that are built on top of Ethereum, they each generated more revenue than Ethereum itself. And those 5 were Tether, Circle, Sky, Athena, and Aerodome. So I thought that was interesting. Let me ask you this. In another, I think it may have been a white paper that you wrote. I want to read this. You said, while building foundational infrastructure is important, in order to truly succeed, the crypto industry needs to onboard a lot more users. You said the internet grew on the back of killer apps like email, file sharing, social networking, streaming, and mobile. Web3 needs a similarly compelling set of applications to draw in users. And that also jumped out to me because as I think about diversifying beyond some of the largest digital assets, and this case that you're trying to paint here, I'm just curious where you think we're at in mainstream crypto adoption, and maybe what needs to happen. Like, are we still just too early to determine that, or does the industry need to do something different? Is the overall value proposition of crypto just not strong enough at this point? I'm just curious how you think about that overall, because that really then paints a case for diversifying.
Yeah, I'd say that so far in terms of finding these quote unquote killer apps, we haven't, as an industry, done that well. I mean, I'd say stable coins on ETH and maybe Solana-based meme coins up until recently were considered killer apps. But I think you have to remember that, the approach that the industry has taken towards building out, towards investing in these 2 competing layers, the yin and the yang, right, protocols and apps, has not been completely irrational. Right? You remember back in 2021 when there was a big NFT drop and it would break the blockchain, right? Clearly we were not ready for prime time at that point. And so, the fact that all the builder energy and investments from VCs and other folks have been spent on upgrading ETH, creating L2s, rollups, and competing L1s has not been, it's been logical that we've needed to solve that problem. Now, I think the problem is that moving forward, that it's kind of at this point a solved problem. We're pretty much there. The technical throughput issues are, resolved or will be resolved in the next few years. We have a kind of clear path to success there. And so the gating item for adoption, as you point out, is not necessarily on the technical side, the infrastructure side, but is more on the app side, right? So I think back to, when I was a kid, I bought an Xbox, right, when it first came out. And, why did I buy an Xbox? Because it's the same thing as a PlayStation or whatever the Sega one was. And the answer was they had this game called Halo, right? And if you remember, Microsoft actually bought this game studio called Bungie that made Halo, made it an exclusive game to them. And so I wasn't buying Xbox because I thought it was better than PlayStation. I was buying it because I wanted to play Halo with my friends, and they were all playing it, right? And so I think this is a good example of why apps are necessary to onboard into users into crypto, right? People don't care. When they used Facebook in the early days of Facebook, right? They didn't care if it was built on PHP or Python or C++. They cared that they could use an app that worked and their friends were on it, right? And I think the same thing. I don't care if app X, which I interact with, is built on Solana or Ethereum or Bitcoin. That doesn't matter. I think too many people in the industry are unfortunately very tribal in trying to fight with each other over which is the best underlying infrastructure, where the end user doesn't really care about that. And I think one thing I actually mentioned in the letter is this like move towards certain apps, right? I think Uniswap, Athena, and Hyperliquid were the examples where these are apps that have lots of followers and users are now starting to roll out general purpose blockchains with the idea that they can leverage their relationship with the end user because that's where the value is. And who cares about the underlying infrastructure that's commoditized, right? I can build it on anything. And so we'll see if they're successful. Maybe they won't be. But I think that does indicate that there might be a vibe shift with regards to this point. And I think the final point, just from an investment standpoint, is what really matters is not so much if you're right, but if you're right and the market's wrong, right? You need to have a differentiated view, and prices and valuations are important in as much as they tell you what is everyone else thinking, right? And where might they be wrong? And if you look at, like, for example, the stat I just mentioned, where 70% of revenues are earned by applications which represent 10% of market caps, which implies that 90% of market cap is behind these L1s that generate 30% of fees, right? You don't have to be like a CFA or whatever. You can do some basic math to know that the price to sales ratios are wildly out of whack there. I think there's a 4 to 5x gap, right, between those two things. And so from an investment standpoint, if I say nothing else, is look, the market's baking in a huge premium to be investing in L1s, right? And that I think is partially due to the influence of the fat particle thesis that people believe that there's no value in apps, and there's only value in L1s, and hence every VC fund has gone out to raise all this money to launch yet another L1, which we don't need. We don't need more L1s, right? We need users, and we get users through apps. So look, I mean, that's me getting on a soapbox here, but I do think that for the industry to succeed, you need to onboard the next billion users, and that needs to be done through cool apps, not through some kind of upgrade to some blockchain somewhere where that again no one really cares about aside from the people who are really deep in the weeds.
Okay, so let's talk about how you're taking that overriding philosophy and now applying intangible value from an investment perspective. And I alluded to this earlier. I love this because crypto assets are obviously highly intangible, right? And so it makes sense to have some sort of framework there to put a value on that. So just tell us a little bit about your basic framework here. How are you applying intangible value to crypto?
Yeah, so I think even before we get there, I think let's redefine the problem. So let's imagine you're on board. You say, look, I wanted to get diversification. Even though it hasn't worked the past 3 years, I think that things are going to shift around and the next 3 years will be great for small caps. Okay. Now you say, all right, well, let me just go out and buy an ETF. Well, can't do that, as you well know. There is no ETF for small cap tokens, and there will likely not be for a long period of time, if ever. And so, how do we go about doing that? And I guess why, right? So first are the operational considerations, liquidity and access to exchanges, et cetera, which is probably the main blocker there. But if you ask, like, what is the true problem, is that a lot of these altcoins are actually not good investments, right? Like in any venture style arena, 95% of startups will fail, and that's the same here, but even probably more extreme. You have a ton of vaporware. You have a ton of projects that may have a handful of users, but are just way overvalued relative to what they deserve to be. So even if it were operationally feasible to build an index around the small cap space, would you actually want to do that? Probably not, right? Because you would just know up front, right? Right off the bat that at least a quarter to half what you own, if not more, are vaporware, things that you shouldn't be owning. And so the question is, can we apply a value lens to this to do two things? So first is there's this idea in traditional finance called X-dexing, which is think about the small cap index, just get rid of the worst things there, and suddenly your profitability of the average company goes up a lot. It's like if you're trying to go on a diet and you just cut out French fries, that gets you 80% of the way there. So that's one thing you can do, just get rid of the things that have no real usage or are way overhyped. But then why stop there? Why not just say, all right, well, let me actually not just get rid of the bottom quartile, but actually just focus on the top quartile. Find things that actually are gaining a lot of traction and yet are trading at a deep discount to that on a relative basis, at least. And so that's the general approach, which is we want to use a valuation metric to invest in the space as a way of getting rid of vaporware and overhyped assets and concentrating on the kind of most undervalued things. So then the question is, what is that metric and how do you get to that? So you already in the intro kind of gave away my thing here, which is so in the equity space, or when we first came up with this framework, and it's really universal, we said, what matters today is not tangible but intangible capital. intangible capital can be broadly segmented into 4 categories: intellectual property, brand equity, human capital, network effects. And then when we built this out in the equity markets, we said, all right, well, the first thing you want to do, let's take an example, is like IP, right? We say, all right, like, let's imagine we're trying to assess the IP of a set of companies. How would you do that? Well, one of many different ways you could do this would be to start by looking at the patent portfolios of these companies. And you would say, all right, well, like this company X has all these different patents. Let's go through all of them and score them based on how innovative they are. Are they leading edge or lagging edge? And kind of put some qualitative adjustment in there, and then give them a quality adjusted score of number of patents. And then what you would do is you'd say, what is the price of that stock or the market cap of the stock relative to the patent portfolio? Because if you didn't normalize at all, you would just be long large caps, right? So you want to say, for each dollar invested, how much IP am I getting out? Now, if you wanted to do that in the crypto space, you don't look at patents, obviously, since it's not a meaningful thing that's done in the industry. But because in this case, a lot of these companies or these projects are open sourced, you could go to GitHub itself, look at the source code itself, say, what is the quality of these various code bases? How much are they iterating on these things? How many active developers are there, so on and so forth? And again, score by the market cap, so relative to market cap. Otherwise, you're just buying ETH. And what you can uncover is, for a given sector, say like DEXs, there's going to be a handful that are actually doing a lot more innovation than others, or say in Deepin. Then the next thing you look at is to go horizontal now, would be say on the brand side, social media, right? A lot of the coordination within crypto is done in decentralized manner over the internet via Telegram or Twitter. You can look at all these data and say, hey, which projects have a significant following of engaged followers, like a lot of people who are paying attention and part of this community, and again, relative to the market cap. And then the final piece would be on the network effect side. A good analogy would be in traditional markets. If you're trying to evaluate Visa as a company, which is a payment network, you'd say, all right, well, the value of Visa is going to be proportional to how much transactions are flowing through its network at each point in time. And each quarter, you could get the 10Q and figure out what the number was for that quarter with a lag. Right? The nice thing about crypto is because blockchains are kind of permissionless and basically real-time updated, every few seconds you can figure out, all right, well, how much transactions are going through, say, Ethereum each point in time, and kind of put together a financial statement, I guess, on that basis, right? And again, you'd want to look at the price of the asset relative to how much volume is going through, how many daily active users, which would be kind of a SaaS-style metric. And so you can put these things all together. But the point being that there's dozens of these things, and you can create a composite of price to X, where X is not book value as it would be in a traditional value approach, but X is all these different intangible metrics that then create a single score for each token, and then from there you can build portfolios as you see fit.
I absolutely love this, and we don't have to get too far into the weeds, but I'm curious, how are you actually compiling all of that data? When you talk about, I love the network effect component and applying that to crypto, but when you think about, for instance, social media and the interactions there, obviously the transactions, that on any particular network, that's all out there, but how are you actually going about compiling that and putting it into something that's digestible?
Yeah, I mean, look, the good thing is that most of the data is pretty structured. Some of the tweets and stuff are not structured. But generally, generally the information is all available. I think that's the most important thing, right? In equities, there's this idea of MNPI, right? Versus publicly available information. In crypto, everything is by definition being built in the open. It's all done on these ledgers, which are completely they are the source of truth. There's no ability to kind of in traditional markets, occasionally you have these frauds where companies will lie about their financials and the auditor won't catch it, and then they get into big trouble. In this case, you can't really do that because it's right there in the ledger, which is pretty cool. So I think that's the most important thing. How exactly it collects it varies case by case. In some cases, there are aggregators out there, analytics platforms that pull the data together. In other cases, you can get it directly. And that will obviously change through time depending on, as things kind of evolve.
And briefly here, just talk more about the factor side of the equation and how you're applying that to crypto. So clearly we're talking about intangible value here, which I think is, you may label this differently, sort of a subcomponent of value investing overall. And I should have mentioned this earlier. I think you alluded to it. So you co-managed a quant hedge fund at Kaleidoscope Capital. Prior to that, you were at GMO. You were a member of Jeremy Grantham's $40 billion asset allocation team. I know you also work closely with their equity and macro investment teams. The point being, you clearly have a deep background as a quant factor investing. And so, just again, at a high level, talk about how you're bringing some of that to crypto as well. This is all interrelated, but talk specifically about that.
Yeah, so I wrote a paper in Feb 2024 called Crypto Factor Investing, and that's where a lot of these ideas were kind of published. And to be honest, like it wasn't so much. I didn't put it so much out because I thought that this was like going to be something that's immediately useful. Because if you remember, like you think back to like the way that the traditional markets evolved, right? In the 70s and before, you were buying single stocks on your own, paying huge commissions to do that. Then there were mutual funds, and then index funds and ETFs, and one other kind of interesting outgrowth later on down the game was what's called like smart beta or factor investing. And the idea here was that people realized that a lot of these kind of 2 and 20 hedge funds were effectively kind of running exposure to certain factors. And then there were ways, and maybe if we just packaged them instead as ETFs or mutual funds, we could, and did it systematically, we could offer this sort of exposure in a kind of cheaper, more cost-effective, transparent way, right? It was systematizing, alpha. So you think of alpha becoming beta, there's this middle category of like smart beta, which is priced in between those two things. And that was a big development in equities and still is, right? There's hundreds of billions of dollars. I mean, you would know better, managed in smart beta ETFs, things like that. But so kind of the idea was, and again, like I'm definitely early on this because I'm still early on the idea of diversification, which is to me kind of mind-boggling. People should be doing it as of 3 years ago, but I'm glad they didn't because they did better not doing it. But I think that over the next few years, we'll see diversification start to be taken more seriously as crypto becomes a more kind of true asset class with subsectors in the same way that the S&P 500 index now exists with different subsectors, et cetera, small caps, large caps, mid caps. But then the next thing after that, so this is now thinking like 2 moves ahead, right, is this idea of maybe trying to kind of get some of the factor investing into the crypto space. And so, judge me on this in 10 years, not even 5. But the idea is this, which is, as I mentioned, there are certain factors out there that people have shown over the past, say, 100 years have demonstrated excess returns within equities. The most famous one is the value factor, which we touched upon, price to book, low price to book stocks outperform high price to book stocks. There's also momentum, which is when stock prices move up, they tend to continue to move up. And when they move down, they tend to continue to move down, at least on a relative basis. That's momentum. There's equality, which is stocks with high profitability tend to outperform those with low profitability. And then there's a size factor, which is, at least this is under contention, but small caps have historically outperformed large caps. And then, of course, the main factor, which is the market factor. The stock market tends to go up, right? So you have like 6 or so factors out there that are predominantly used. Of course, anyone could invent more, but those are the main ones. And so I asked the question, which is, can we take these kind of well-known asset pricing models, these factor models, into the crypto space, and will they work? And the kind of TLDR is yes, they do work with some adjustments. So first of all, I had to throw out the profitability factor because these are emerging technologies. These are kind of like startups. They don't really have well-defined profitability metrics. The market factor works. The size factor worked with some caveats. Momentum worked with some caveats. And then the final piece was, as we started the conversation discussing, because crypto is mainly intangible, the kind of traditional price to book value index didn't work, signal did not work. So I just swapped it out for intangible value. So if you swap traditional value for intangible value, then that tends to work. So in this paper, I looked at the market factor, small cap, momentum, and intangible value. Those are kind of the 4 factors. And broadly speaking, they all seem to have kind of historical risk premiums or return premiums associated with them. 2 of the interesting findings, I guess, from the research were first, on the intangible value side, was that it tended to work better in small caps than large caps. And this, I said, would look pretty consistent with the literature within equities, which is, most strategies work better in small caps than large caps. They're less efficient historically and are more like frontier asset classes, of which like small cap crypto is like as much as frontier as I can think of. So it makes sense that there'd be outperformance. And then the other piece, which I touched upon in the paper, which is kind of interesting, is while there's no quality factor per se in crypto, to some extent, intangible value can serve as a proxy for quality, a quality filter. And so there's this work that suggests that in that in equities, small caps don't work anymore. Small cap premium doesn't exist anymore. And what some researchers have shown is that actually the reason for that is that there's a lot of junk stocks, so unprofitable stocks within the small cap space. if you just get rid of those things or adjust for them, then it starts to work again. Small cap tends to outperform large cap. And so the same thing happens in this case, which is, within the large cap space, you have Bitcoin, ETH, these are real projects. But as you go down, you get a lot of fake things. And, to the extent where using a price to intangible value metric is a backdoor way of effectively weeding these guys out. Because if you have no intangible value, if you have no users, then your denominator is zero, you're undefined, you're done, right? And so one thing I found was that intangible value is implicitly filtering out a lot of the kind of vaporware from the small cap space. Hence why it's so much more powerful in small caps than in large caps, where the average project is actually legitimate. It may not be good for other reasons, but has at least some users. And then on the momentum side, the main difference between equities was that in the equity space, we tend to think of momentum as being a 1 month to 12 month look back. So returns over the past 12 months, excluding the past 1 month, is the factor people tend to look at. In crypto, I found that it compressed significantly to a time period of weeks. So assets trended more in the weekly as opposed to annual horizon. And that's because these are just fast moving markets. Crypto is much more dynamic than the equity markets. The other thing that was different about momentum I found was that whereas I told you just now that most factors work better in small caps or in equities, this is actually the opposite, where in crypto, momentum works better in large caps than small caps. And there's a few reasons why, I could speculate that this would be the case. Most people who are traders trade large caps because they have more liquidity. Large caps tend to be more macro, like digital gold in orientation. And as a result, they reflect the momentum that macro itself has, like inflation and growth has. Most people, when they want to lever or short, they do it in the large cap space. And hence you have this embedded leverage, which leads to kind of the cascading deleveraging and releveraging cycles. And then finally, in small caps, there's a lot of this weird microstructure where you do have a lot of mean reversion, which you avoid by going to the larger cap space. So yeah, there's a few distinctions between momentum and intangible value in crypto as opposed to equities. But broadly speaking, what was really cool was I could take this framework and more or less port it wholesale into the crypto universe and have it kind of be a plug and play and have it start working. And so, again, we'll see if this is actually useful to anyone, right? I think we still need to walk before we run. I think we still need to get folks to kind of think about just building out a portfolio of altcoins to start out with before they even start thinking about how to layer on, various style boxes and exposure to large versus small, value versus growth, et cetera. But I think we'll eventually get there. And, my thought process was, why not publish this now and, get it out there in the world, and, maybe someone will read it, and, it'll help kind of spur the process of building, towards this new paradigm eventually.
If you had a guess, and this is a loaded question and one I'm sure we could talk about for a few hours, but would you expect the efficacy of these various factors to improve or increase as the crypto market matures, or perhaps diminish? Because that's, I think, a question some people may say, okay, now in this current market, it's very immature. There's a lot of things moving around. So maybe some of this will work better. Any strong views on that?
Yeah, I'd say from first principles, you would expect these things to decay over time, as they have in the equity markets, for what it's worth. But, I think people are too quick to, impose their kind of like first principles thinking into markets, because empirically, like, the reality shows that things are way slower than you would expect based on just logic alone. For example, in 2014, when I started doing crypto, there were all these strategies. I was like, these are crazy. I can't believe these exist. They're going to go away next year, right? So part of the reason why I was like, I'm just going to go back into TradFi is I said, look, one of two things is going to happen. Either the market matures and, I can take a lot more dollars, so it's a lot higher capacity, but the inefficiencies go away, or the market stays small and inefficient but never grows. And the crazy thing is that the market's grown and stayed somewhat inefficient. Like, it's less inefficient than it was in 2014, but obviously it's still very inefficient, at least relative to equities. So I think, long way of saying to your question, yes, I think that over time these opportunities will start to diminish, but the half-life is going to be longer than most people think.
And real quick before I let you go here, and you touched on this a couple of times throughout our conversation, but in terms of integrating crypto into a well-diversified portfolio. So when I say well-diversified portfolio, I'm just at a high level, I'm saying one that includes global stocks, global bonds, perhaps some other asset classes as well. I'm curious how you think about including crypto in that. Like, is that something that you believe most investors should be considering, or is this still too early stage? and maybe should be thought of more as like a VC investment, which isn't for everybody? Just high level, how do you think about the role of crypto in a portfolio?
Yeah, so I think there's like two ways of thinking about it. So I think the first one is like the most kind of brain dead way, which is, imagine you're an efficient markets guy and you say, all right, well, like I don't know anything about anything. All I know is that prices are efficient and they adequately reflect underlying fundamentals. Therefore, I should buy everything in proportion to its market cap. This is a very common view, right? And that's why we have market cap weighted indices like the S&P 500. Well, if you did that, you'd say, all right, well, all crypto together has a market cap of like, I think 3 trillion. Is that right? And so that's about the same size as Apple, right? So if Apple is a 7% weight in the S&P, to put the same amount into crypto, even if you hate it, right? Like I may hate, GameStop or some specific stock in a stock index, but it's in there, it's fine. Like it's just weighted, proportionate to its size. So I think that would be, one argument to include. I think that's like your kind of know nothing argument. If you, wanted to be a bit more sophisticated, you could say this, which is, Bitcoin, let's separate Bitcoin from everything else, because I think Bitcoin is a kind of unique asset, or at least has taken on unique properties. If Bitcoin truly is digital gold and is more of a macro asset, it trades as a substitute towards physical gold and to the US dollar, perhaps, in this kind of trade war environment we sit through now, then maybe it behaves with a lower correlation to stocks, which is the main risk factor, right? Most people, even if you own 60-40, stocks comprise 90% of the volatility. Great Value taught us that, right? And therefore, Bitcoin might be interesting as a uncorrelated or hedging type asset, similar to how commodities in, again, Bridgewater's all-weather portfolio have an outsized role relative to the market cap. And then if you go to everything else, right? So I think it's even helpful now to separate into two categories. So you have your like Ethereums and other layer ones. Those are around the same market cap size as like Salesforce, right? So I think 300 billion or something around that, $200 billion, right? So think of those as being kind of like large cap public companies in size. Whereas your altcoins, so everything else besides those few big layer ones, are between Series A and Series D venture style companies in terms of market caps. And so I would think of these as being kind of liquid alts or liquid venture investments. So to the extent where there's been, as you know, a big move towards putting private markets into investor portfolios, interval funds, democratization of alts, et cetera, to the extent that there's demand for venture style investments, I would say that this crypto stuff is pretty interesting, these small caps, because they fulfill the same early stage exposures to this emerging technology, but they do so in a liquid format where you're not locked into a 10-year fund. You can, in theory, if you do it on your own, trading out, or if you do it through a manager, you have some quarterly or annual liquidity. And by the way, this liquidity is very valuable, particularly valuable in crypto. So one thing that I would say as a first approximation is the value of liquidity is, as an option, right? The option to trade and change your mind is a function of the volatility of the space. And so for a very mature market, no one really cares. But for a very fast-moving market where the best projects today may not be the best ones tomorrow, the killer apps may not have yet been invented, right? They're coming out next month, let's say. You really want to reserve the option to trade. You want to be able to course correct and to have liquidity to be able to do that, which traditional venture equity investors don't have, is actually very meaningful, very valuable. And then paired with that is this idea of volatility harvesting, which is imagining fundamentals are held constant, but Mr. Market has these kind of mood swings where prices go up and down randomly through time and tend to mean revert, as I mentioned earlier, for small caps. If that is the case, then you have some value in being able to kind of trade around fair value. So as an asset spikes up in price, you sell it, it comes back down, you buy it, you sell it, you buy low, sell high. And that's, I found to be pretty accretive as well. And so the value of liquidity in the liquid alts component is actually non-trivial. It's not just a substitute for venture. It's actually, in my mind, kind of interesting, in some way superior. Now, there's some kind of adverse selection issues, so you have to be thoughtful about what you own. But at least as a structural thing, could be kind of an interesting substitute towards a venture style portfolio. Of course, it's only in one vertical. So whereas a true venture portfolio, you can own some AI, you own some biotech, you own some crypto. Crypto through tokens is only one subset of those things. So you want to size it appropriately. But to go back to your question, for those investors who are saying, I start with my stock portfolio, maybe I own some Bitcoin to hedge in the same way I might own gold or other commodity plays, and then I might own some of these, some allocation to venture or PE, and I would say this liquid venture, small cap crypto stuff could go in there as well. So there's kind of different ways of thinking about sizing or how they fit into a portfolio, which again depends on what you hold, and no one's portfolio is the same. But yeah, that's just, I guess, a long way of saying that. Yeah, I think that these assets have pretty interesting properties, power law returns, upside, especially for the small caps, which I think could be additive to a portfolio depending on each individual circumstance, of course.
Well, and that's really interesting framing when you consider how many fund companies right now are trying to bring private assets into a vehicle. For you and I on the ETF side, we're seeing that. But I saw today, Vanguard partnering with Blackstone. There's a lot of this in trying to bring a different pattern of returns to the end retail investor. So I like the way you framed that with crypto. But Kai, I knew I was going to enjoy this conversation. I just 100% knew it when we were in Vegas and chatted about this. You certainly didn't disappoint. And I'll just say, I know you're a very humble person, but for anybody out there who's trading crypto, you're trading against Kai. I don't know that you necessarily want to do that. I think the level of diligence and intelligence comes across crystal clear here. But Kai, thank you so much for joining me.
Thanks a lot. This has been fun.
That was Kai Wu, founder and chief investment officer of Sparkline Capital. Hope everyone enjoyed this episode of Crypto Prime. Please leave a review or give us a like wherever you're listening or watching. That obviously helps other people find this show. And always feel free to send me questions or comments. You can do that at cryptoprimepodcast.com. See you again next week.
Crypto Prime is hosted by Nate Geraci, president of OTR Media LLC. Nate is also president of the investment advisory firm The ETF Store. While OTR Media LLC and the ETF Store are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by the ETF Store. This program is for informational purposes only and does not constitute investment advice. Investing in crypto assets involves substantial risk, including the potential loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Visit cryptoprimepodcast.com for more information.